Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 2nd of August 2020, and yesterday we published our Gold and Silver Weekly Update for the week ending the 31st of July, and we've placed a link to this in the description box below if you haven't had an opportunity to listen to it. Now, in that video we highlighted that the United States will be announcing a significant amount of economic data this week, literally each day, all of which could have the potential to affect equities, the dollar, and precious metal prices. Perhaps the most watched or looked out for will be the ADP employment figures on Wednesday, the weekly jobless claims on Thursday, and then, of course, the non-farm payroll report on Friday. However, we should not discount the other data either, as combined they should present a relatively clear picture of where the US is heading. Now, that said, we must also be mindful that not even the United States operates in a bubble and is also affected by external forces. Well, this coming week, several central banks will be making announcements, any of which, and most certainly combined, could have an impact on the US and particularly the dollar. We shall now look at an excellent article published by Bloomberg early this morning, which addresses this issue and what we can expect for the week ahead. Bloomberg article, dated August the 2nd, 2020, at 3 o'clock a.m. GMT +1, by Craig Sterling and Scott Lanman. Headline: Monetary nerves fray on 4 continents. Economy week ahead. Central banks on all 4 continents will project a collective message of nervous unease in interest rate decisions this week, as the persistence of the coronavirus impedes economic recoveries throughout much of the world. Monetary authorities in Brazil and India, both enduring acute outbreaks of the disease, will probably cut benchmark borrowing costs. Others, from the United Kingdom to Australia, are likely to pledge heightened vigilance and continued support, similar to that offered by the US Federal Reserve when it left rates near zero on Wednesday. The unprecedented growth crisis caused by the COVID-19 virus has provoked easing from central banks everywhere by officials who know the most optimal stimulus, a vaccine, is one they cannot offer. Monetary institutions normally guided by economic forecasting are being forced to wait instead for advances in medical science to clear the fog around their policy outlooks. Such is the uncertainty that the Bank of England, which would normally unveil new growth projections at its decision on Thursday, insists on describing them as scenarios, because the coronavirus is defeating its officials' attempts to attach probabilities to the varying outcomes. What policymakers will have to work with at the 7 central banks scheduled to meet in coming days, including the Czechs, Thailand and Georgia too, is more evidence of the economic damage caused by disruptions to combat the disease. Global purchasing managers' indices in most jurisdictions are likely to confirm that the rebound from the worst of the world's lockdowns remain weak, while job data in the US is predicted to show a rebound in hiring slowed significantly last month. What Bloomberg economists say: a likely cut from Brazil, moves in India to give more traction to past easing, and a reassessment of the shape of the UK recovery shows central banks are not out of the game. Still, with the first urgency of the crisis past, markets stable and space to act severely depleted, the focus of attention has shifted to fiscal policy. Tom Orlick, Chief Economist. United States and Canada. The US labour market's V-shaped recovery in May and June probably lost substantial vigour in July, as a resurgent coronavirus forced a renewed wave of business closings and layoffs. Employers likely added just over 1.5 million workers to payrolls last month, or about a third of the prior month's pace, according to a Bloomberg survey ahead of Friday's Labour Department report, which covers the period through mid-July. The jobless rate is projected to drop by 0.6 percentage points to 10.5%, compared with a 2.2-point decline in June, and still triple the pre-pandemic level of 3.5%. A day before the jobs report, the weekly figures on filings for unemployment benefits will indicate whether the labour market slowdown further deepened in late July. Last week's report showed a second straight increase in initial filings, along with the biggest jump in continuing claims since May, ominous trends that could presage a stall or even a drop in jobs in August. Europe, Middle East and Africa. With the Bank of England not expected to take any action in its meetings next week, the focus will be on signals of future moves, particularly whether policymakers are inclined to take interest rates below zero. The Czech central bank, which announces its decision on the same day, is also expected to keep rates on hold. More than a dozen central banks are within 100 basis points of 0%. On the data front, high-frequency indicators for the United Kingdom and the euro area are expected to confirm the rebound taking place in the third quarter. Figures from Sweden, on the other hand, will give a fresh glimpse into whether the country's relatively lax approach to the COVID-19 pandemic has paid off in economic terms. Bloomberg Economics expects an 8% slump in output. Asia. Japan revises its first quarter GDP data on Monday, just 2 weeks before far worse second quarter figures are due out. Purchasing manager reports from across the region will be watched Monday to see if the supply-side recovery is holding into the second half. Australia's central bank meets Tuesday and is set to keep its overnight cash rate and 3-year yield target unchanged. On Wednesday, Bank of Thailand is expected to keep rates steady at an all-time low, seeking to preserve its limited policy space in case the economy worsens further in one of the last MPC meetings chaired by Governor Veritai Santiprabhu. India's Monetary Policy Committee is likely to cut rates on Thursday to shore up the growth outlook, despite a recent surge in headline inflation. On Friday, China will release trade data for July. Latin America. On Monday, Colombia's central bank posts the minutes of its July 31st meeting, where the key rate was cut to 2.25%, with possibly one more quarter-point reduction on tap for August. 2 days later, Brazil's central bank looks set to extend its third longest easing cycle of the last decade, with a quarter-point cut to push the overnight rate to a record low 2%. Report on Chile's economic activity and Brazil's industrial output for June will indicate nascent rebounds even as the year-on-year figures show double-digit declines. Lastly, July consumer price data from Peru, Colombia, Mexico, Chile and Brazil should confirm that inflation rates are either within or even below their respective target ranges. End of article. So even the so-called expert banks and bankers cannot predict what is likely to happen with the economy, with COVID-19 basically dictating the future for us all. It's an awful thing to admit to, but the worse the pandemic, the better it will appear for precious metals, and the worse it will be for the US dollar. Now, we felt it was important that you should be aware of what is going on in the background internationally, and this coming week should actually prove quite important in terms of prices and markets generally. What do you think? Do you think there will be further rounds of QE, which is almost a given? And can we see more central banks move into negative interest rate territory? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.